Let's go and have a look at what happened with the Australian dollar today off the back of the US Federal Reserve decision and also that strong employment data. Well, the Australian dollar right now back above 73 US cents. It's been its best day in more than a year. Joseph Capurso is the Commonwealth Bank's Head of International Economics. He joins me now. Joseph, always good to chat to you. I just wanted to ask first up, of course, the Australian dollar, very, very strong. You've had two very positive pieces of news coming out today. But strangely, why is it that the markets seem to respond so well to interest rate rises in the United States?
Because interest rate rises in the United States are a good indicator that the US economy is strong. And given the large size of the US economy, if the US economy is in good shape, it implies that the rest of the world either is in good shape or is going to be pulled along by that stronger US economy. So it's a sign of strength, not weakness.
OK, but the potential of as many as 6 more rate rises in this cycle, I mean, that's a really sort of significant increase in the price of money, along with every other inflationary pressure that's coming right now. Is that something long term that economies can cope with, as many interest rate rises as that?
I think so, and particularly in America, where their mortgage market is very different. 6 interest rate rises this year is what the Fed is indicating, and we agree. We think that's most likely. Financial markets, though, they've already priced that. They priced that many months ago. So you've already seen it influencing mortgage interest rates in the US quite a number of months ago. So, look, the impact's already hit in the US economy, but the US labour market is just so strong, it's so tight, that, look, I think the US economy, if anything, is going to need more interest rate rises, not less, to cool inflation down, which is extremely high in the US, about twice as high as what it is in Australia.
Twice as high as it is in Australia. But, of course, we don't go alone in this world. And the suggestion is, of course, that Australia is going to see many of those price increases. Fuel is one of those. We're seeing the price of food increasing with wheat prices rising. Metals prices are rising. That's affecting tin plate and a range of other things. Is it inevitable that Australia has to go the same way?
We will be increasing interest rates in Australia, no doubt about that. But we don't think that the Reserve Bank of Australia is going to hike interest rates anywhere near as much as the US Federal Reserve authorities will. In fact, we think that US inflation, about double what it is in Australia, means that US interest rates will be about double what they'll end up being in Australia too. So we think the peak in the Australian official interest rate will be still quite low, 1.25% in about a year to 18 months.
So given that, interesting part about this, is the Reserve Bank right now behind the curve? I mean, it's waiting for inflation data. It's waiting to see some sort of official notification that wages are breaking out beyond that 3% mark. But is there a danger now that it is behind the curve, that it will have to play catch up and maybe have more interest rate rises more quickly than what otherwise might be preferred?
Look, that certainly is a risk, Ross. But look, we're reasonably confident that you're going to, unlike the US, you're going to get a gradual increase in both inflation and wage growth in Australia. And that's certainly what we've been seeing for the past year or so. So if the Reserve Bank is behind the curve, as you say, well, the US is a very, very long way behind the curve.